This is question number 3 on homework 4 for module 4 on the credit risk analysis. So this is basically a question about a comprehensive example of conducting credit risk analysis. We need to calculate a bunch of different ratios, and based on the values of those ratios and do a sort of analysis. So we're provided with the income statement, balance sheet, and statement of cash flows for Lockheed Martin Corporation. So the company name here may vary, and also the different financial statements and as well as the numbers may vary. So we have the income statement here, a balance sheet, and also the statement of cash flows. So part A is compute Lockheed Martin's current ratio and quick ratio for 25 and 24. Notice here the rounding requirement. Round your answers to 2 decimal places. So the first step is simply to copy all these financial statements into Excel to facilitate the calculations. So that's what I did. So here I basically have all the numbers available on my Excel sheet already. And first is the current ratio, right? Current ratio is calculated from the balance sheet. So current ratio is defined to be current assets over current liabilities, right? So current ratio is simply that's current assets. So we look for current assets is right here, the total current assets. So let me first highlight this so you know which row I'm looking at. Here, highlight that in yellow. So this is total current assets, and then I'm looking for total current liabilities. And later on, when I calculate the quick ratio, because quick ratio is cash and cash equivalents, short-term investments, and receivables, right? The sum of the 3, and then divided by the total current liabilities. So I'm gonna highlight these 3 in yellow as well. So let's start from current assets, current ratio. So this is current assets, which is right here, 10,449 divided by current liabilities, 9,428. And then pay attention to the rounding requirement. Here, I think we read that round your answers to 2 decimal places. All right, so let's keep that. Format cells and keep the number, use the number, and keep 2 decimal places. And then I can also drag the cell to the other year, and Excel will automatically calculate current ratio for the other year. And quick ratio, as we said, quick ratio is, go back to my lecture slides, quick ratio is cash plus marketable securities plus accounts receivable divided by current liabilities. So go back to my Excel sheet. That's going to be cash and cash equivalents plus marketable securities, basically is short-term investments, and then plus the accounts receivable. So then divided by current liabilities. So also, I'm going to format the cell here to use number and keep 2 decimal places, and then drag the cell to the other year and automatically calculate the same ratio for the other year. So then I will copy the numbers. So for 25, notice here on the left, here is the later year, which is 2005, and on the right is the earlier year, so that's 24. So for 2005, current ratio is 1.11. And for 2004, that's 1.01. And for quick ratio for 2005 is 0.76. And for 2004, it's 0.62. So then we just do a simple analysis based on these numbers. Which of the following best describes the company's current ratio and quick ratio for 25 and 24? So if we check these two values, we can see that both current ratios and the quick ratio has increased from 24 to 2005. So we just look for this part of the sentence to match that observation. The current ratio has increased while the quick ratio has decreased, which is not correct. Both the current and the quick ratios have decreased, not correct. Both the current and quick ratios have increased from 2004 to 2005. The company is fairly liquid. I think we could say that. If further, I think you can check the last one, which is not correct, right? The current ratio has decreased. So only this part matches our observation. Part B, compute total liabilities to equity ratios and the total debt to equity ratios for 2005 and 2004. Again, round your answers to two decimal places. So total liabilities to stockholders' equity, and this is basically total liabilities to stockholders' equity. This is basically defined to be total liabilities. Right. First, again, let me highlight that. Actually, in this case, I need to insert a row which is total liabilities, because there's no direct total liabilities item available. So I need to do actually a calculation myself. So total liabilities basically is the sum of the total current liabilities, long-term debt, accrued pension liabilities, other post-retirement benefit liabilities, and other liabilities. So basically, I can just simply sum up all the items starting from the total current liabilities and until the other liabilities. So that's basically what we can do. And then we can drag the cell to the other year. So now I can highlight these total liabilities, and also let me highlight the total stockholders' equity. So total liabilities to stockholders' equity now can be calculated. Again, check my, this is a current ratio and the quick ratio are liquidity ratios. And the total liabilities to stockholders' equity ratio is basically a solvency ratio, right? Total liabilities to equity ratio, total liabilities divided by stockholders' equity is one of the solvency ratios. So it's total liabilities divided by total stockholders' equity. Again, keep format cells to keep two decimal places, and then drag the cell to the other year to calculate the same ratio for the other year. So then go back to the problem. The other part of this question is 2005 total debt to equity ratio. So debt to equity ratio. So debt to equity ratio, let's go back to my lecture slides, which is long-term debt is defined to be long-term debt including current portion plus short-term debt divided by total stockholders' equity. So basically, the numerator here is the interest-bearing part of the liabilities. So it doesn't include items such as accounts payable, and probably some accrued expenses, which do not pay interest. So now let's go back to the Excel sheet. This is the debt to equity ratio is defined. First, the debt part is first we need the long-term debt, right? Long-term debt. And then we also need the current maturities of long-term debt, because that's also interest bearing. And I guess these are the only two items which we should include in the numerator, because salaries and customer advances and accounts payable and probably other current liabilities, they are not interest bearing. So we should not include them. And the long-term debt, right? The long-term debt is right here. So so debt to equity ratio now can be calculated by the basically the current maturities of long-term debt, 202 plus the long-term debt. So that's my numerator, and denominator is the same as the total liabilities to stockholders equity ratio. So which is the total stockholders equity. So again, let me format a cell to keep only 2 decimal places, and then drag the cell to the other year. And this will automatically give me the ratio for the earlier year. 2005 total liabilities to stockholders equity is basically this number here. And 2004, it's this year, or this number. And total debt to equity ratio for 2005 is 0.62, and it's 0.75 for 2004. So if we just do a quick observation, we can see that both ratios actually went down from 2004 to 2005, right? So then we can use that observation to see which of the 4 choices here matches that. The total liabilities to equity ratio has decreased, so that's correct. While the total debt to equity ratio has increased, that's not correct. And the total liability to equity ratio has increased, which is not correct. And both the total liabilities to equity and the total debt to equity ratios have increased, which is not correct, right? Both the total liabilities to equity and the total debt to equity ratios have decreased from 2004 to 2005, which is correct. And difference between these two measures reveals that any solvency concerns would be for the short run. Actually, the lower these ratios, the less concern for the solvency, right? Because the higher ratio indicate the firm has more liabilities that need to pay. So this part of the last choice is correct. And part C, compute times interest earned ratio, cash from operations to total debt ratio, and free operating cash flow to total debt ratio. Again, round answers to 2 decimal places. So times interest earned ratio, right? This is based on income statement, right? TIE. So this is basically, go back to my lecture slides. This is EBIT divided by, right? This is times interest earned ratio, which is EBIT, earnings before interest and taxes. EBIT divided by the gross interest expense. So EBIT many times is simply the operating income, right? Or sometimes called operating profit. So let me highlight this in yellow. And interest expense is typically the item right below the operating profit. So TIE can be calculated by basically the operating profit and then divided by the interest expense, right? And then I can drag the cell to the other years and automatically calculate the same ratio for the other years. So now let me go on to I'll change the format later on when I do all the after I've done all the calculations for the other ratios as well, just to save some time. So the second ratio is cash from operations to total debt, right? Cash from operations to total debt, right? So this is, go back to my lecture slides. So this is basically defined to be cash from operations. So this item is from the cash flow statement and divided by short-term debt plus long-term debt. So basically, we have done this part of the calculation for the debt to equity ratio, right? In the debt to equity ratio, we have calculated the sum of the short-term debt and long-term debt as our numerator. But here we need to use that as the denominator. Cash flow from operations basically is the operating cash flow. So we can directly find that item from the cash flow statement. And first, let me highlight that again so you know which number I'm specifically using. So it's gonna be net cash provided by operating activities. So I'm gonna use the numbers on this row to calculate cash flow, cash from operations to total debt. So this is gonna be equals 3,194 divided by the sum of the current maturities of long-term debt and then the long-term debt and close, and then drag the cell to the other years to automatically calculate the same ratio for the other year. And we only have 2 years statements of cash flows. That's why the other year couldn't be calculated. So finally, go back to the problem again. The last ratio is free operating cash flow to total debt. So the denominator is the same as the cash from operations to total debt. The difference is the numerator, free operating cash flow. Go back to my lecture slides. So free operating cash flow to total debt is defined to be cash from operations and then subtract capital expenditure. So the difference here is that on top of the cash from operations, on top of the numerator of the cash from operations to total debt, we need to subtract the capital expenditure. So where can we find the capital expenditure? We can find that from the cash flow statement. Basically, that's these expenditures for property, plant, and equipment. So that's basically my capital expenditure. All right, so because this is already in negative format, so we don't have to subtract. We just need to add, right? Because this is already taken care of the signs. Basically, this formula here assumes that capital expenditure is positive, right? We use the positive for capital expenditure. That's why we subtract the positive amount. But since here, it's already the subtraction, the minus sign is already included in the cash flow, so we just need to sum this number up. Okay, so this is right net free operating cash flow to total debt, free operating cash flow to total debt. So this is basically the operating cash flow, right? Basically 3,194. Again, let me open up parentheses here because I need to add this capital expenditure, right? Again, the reason I add is because here we already included the minus sign into the cash flow. Otherwise, we need to subtract. All right, so we're done with the numerator. Denominator is the same as before, which means it's gonna be sum of, again, going back to the basically the balance sheet, right? So it's gonna be current maturities of long-term debt and the long-term debt. Okay. So we're done with this and drag the cell to the other year. So now I can format all these cells once. Number and keep 2 decimal places. And the rest of the job is simply to copy the number back. PIE is right here, and for the earlier year is right here, and cash from operations to total debt is right here, 0.66, and for the 2004 it's right here, and free operating cash flow to total debt is 0.48, and for 2004 that's 0.41. So then we can see that all these three ratios here have been increasing from 2004 to 2005, right? So then we just look for, actually in this case, that's not that simple. I would just need to read it, each of this. Which of the following describes the company's times interest earned, cash from operations to total debt, and free operating cash flow to total debt ratios for 2005 and 2004? Select all that apply. First one is Lockheed Martin's free operating cash flow to total debt ratio increased slightly. Yeah, that's correct. Increased slightly over the year 2005 due to increased cash flow from operations and decreased levels of debt. Actually, to answer this question, we need to actually to do a little bit more calculation, because even though we have summed up the numerator, right? The denominators of the both free operating cash flow to total debt and the cash from operations to total debt, which is both, for both of them, the denominator is the short-term debt plus long-term debt. But we haven't done an explicit calculation for that yet. Let me do that. Short-term debt plus long-term debt. So, and then we can observe the trend. So short-term debt is right here, current maturities of long-term debt, plus then the long-term debt. And then drag the cell to the other year. And going back to the question, it says free operating cash flow to total debt ratio increased over the year due to increased cash flow from operations and decreased levels of debt. So let's see whether the levels of debt has decreased. And that's correct, right? Because this is the earlier year 2004 and this is the 2005. So it decreased from more than $5,000 to less than $5,000. So that's correct. And what about cash flow from operations? So go back to the cash flow statement. So that's also correct, because this increased from below $3,000 to be above $3,000, right, from 2004 to 2005. Actually, that means this part of the analysis is correct. And then let's go on. Lockheed Martin's cash from operations to total debt ratio. So we know that this is has also been increasing. Increased slightly over the year 2005 due to increased cash flow from operations and decreased levels of debt. Oh, actually, for the first part, we need one additional analysis, which is about capital expenditure, right? I think we forgot that. In this case, capital expenditure actually has increased, right? If you look at the absolute value, increased from 769 to 865. So we need to subtract a larger number. So, and now if we subtract a larger number, and that subtraction is done in the numerator, right? Going back to the definition here. So if everything kept constant, we subtract the larger number, and this will decrease the ratio. But our ratio has increased slightly, right? Going back, I'm still talking about the first part, has increased slightly. So that also means this part is correct, because the capital expenditure cannot explain the increase in this ratio. and it's the increase in the cash flow from operations and decrease levels of debt that can explain the increase in the free operating cash flow to total debt ratio. And actually, the same rationale can also explain the second part, cash from operations to total debt. We observe that it has increased slightly over the year, and the reason is actually the same as the first one, because the difference between the cash from operations to total debt ratio and the free operating cash flow to total debt ratio is simply the capital expenditure. The other items are all the same. So, but capital expenditure cannot explain the increase. So, and if you continue to read this sentence, it says due to the increased cash flow from operations and decreased levels of debt. So this is also correct. Lockheed Martin's times interest earned has increased significantly during 2005 due to both an increase in profitability and a decrease in interest expense. Here we can directly observe whether that's the case by looking at the income statement. So this is the EBIT and this is the interest expense. We can see that EBIT has been going up, right? And the interest expense has been going down. So this is correct, right? Because the increase in profitability, that's the increase in EBIT, and the decrease in interest expense, which explain an increase in TIE. And Lockheed Martin's times interest earned decreased, and obviously this is not correct, no. So finally, summarize your findings in a conclusion about the company's credit risk. As we said, this is a sort of a comprehensive example about credit risk analysis. So basically, it did a sort of many different ratios and look at the trend and trying to infer something about the credit risk of the company from comparing those the ratios across the years. Do you have any concerns about the company's ability to meet its debt obligations? We can see that in this case, cash, first, as we already observed, the basically current ratio and the quick ratio are both liquidity ratios, right? Liquidity ratios have been going up, so there's no problem there. And what about solvency ratio, total liabilities to stockholders' equity, and the total debt to equity ratio? This actually has been going down, so also no problem there. And what about these ratios? These ratios has been increasing, right, which is good in terms of the credit risk. So looking at these values, the company doesn't have any potential problem, doesn't have any problem in the near term. So we just look for that. Lockheed Martin's total debt to equity ratio is very low, thus increasing any immediate solvency concerns. So obviously this is not correct, right? Because the total debt to equity ratio has been decreasing, as we observed, has been decreasing over the years. And the lower the debt to equity ratio, actually in terms of the solvency, the better. Right? So it's not increasing the concerns, it's decreasing the concerns. Lockheed Martin's quick ratio is very low. Quick ratio actually has increased over the years. Obviously, this is also not correct. Lockheed Martin's times interest earned ratio is high and has been increasing over the year, so that part may be true, thus lessening any immediate solvency concerns. This is also true. The company's ability to meet its debt requirements will depend on its continued profitability, and that's also true, right? Because the higher time, the times interest earned ratio is defined to be EBIT divided by interest expense. So it depends on a sufficient level of the EBIT to cover the interest expense, and EBIT indicates the profitability. So this actually is correct. So why don't we finish reading the last part and see why it's not correct? Lockheed Martin's total liabilities to equity is high. Actually, as we observed, it has decreased over the year, right? So that's lessening any immediate sovereign concern, and also this is not consistent. If this is high, if this were high, then the sovereign concern actually will increase, right? So that's why this is also not correct. So let's check our answer now. And I think we got every part correct. Okay,